Welcome to Happy Hour. I'm Tracy Burns, in for Rebecca Gomez.
And I'm Cody Willard, and this is where we always do our best to keep it real.
But first, we have to take a look at what happened today.
In the markets. How about it?
Markets. They ended up. That's something.
Yeah, you got a little bit of a rally throughout the day. It was a slow start to the day, and NASDAQ was down most of the day, but by the end, the bulls came through.
Yeah, and we were talking about it earlier. We had that little rumor on JP Morgan that dipped the entire, everything went down because everything just follows in tandem. So JP Morgan came crashing down. Everything came down with it.
Let's tell people what the rumor was. There was a rumor out there that JP Morgan was going to take a lot of write-downs off of the derivatives business, not necessarily the subprime, not necessarily mortgage business. We're talking something entirely, a new can of worms that's opening up for all of Wall Street.
Right, which everyone basically thought JP Morgan was immune to all this. They kind of thought they were Teflon as far as all these messy financial stocks were going. So this was big news. So we went choom.
And, you know, in calculus, the word derivative means taking something down in these other layers, right? And that's the same sort of thing. These guys had taken these things down into so many different layers and repackaged, and so much of that stuff underneath is just junk, and that's what's percolating up.
It sure is.
Derivativating down. I'm creating words on here. Derivitating.
Derivitating.
Yeah.
Well, moral is all the financials went down, but they all came back up. The market ended up for the day on the heels of the Fed news tomorrow that everyone's anticipating a cut, 25, 50 basis points. Yet to be determined.
We're going to talk a lot more about that with our first guest, but I mean, you were saying earlier, you're expecting 25. I think 50 is what the market's looking for. Certainly the Fed futures are looking for 50. The financials, retail, both led the way today. People are looking for this Fed to actually help this market, it seems, or at least the sellers are not panicked anymore.
The JP Morgan news, though, put a dent on things because I think people thought that the financials were slowly working their way out. You know, the retail stocks have seen so much insider buying lately. I think they think that disaster's over, or at least because the holidays are. And so we're starting to come out of the woods, which is why I think we only need 25 basis points.
That being said, the financials have been up almost every day, and they were up almost 3% today. The XLF, one of the biggest indexes or ETFs of it. How about Yahoo After Hours? Coming out after hours. This is the never-do-well internet company. I used to talk all the time, and actually for a while I was. Long Google, short Yahoo. I thought that was a great trade for years. I frankly still do. I don't see Yahoo. I think Yahoo eventually hit, say, 15 bucks. You were saying earlier today that you think they'll get bought at some point. I don't think it'll be above 20 bucks. We'll see. I can't argue. I do think someone's got to take them out. This company is sort of the AOL of 2008.
Yeah, and I'm not sure I actually think you should own it even though they're getting bought out. But there's no way Yahoo will be around come Christmas.
Who's going to buy them? Microsoft, Yahoo?
I think Microsoft's the only logical option. It's like a just dead behemoth right now.
On the earnings front, the biggest issue with the quarter, actually, earnings were pretty good. The quarter itself was all right, but they guided for the full year. They took estimates down. It looks to me like about $400 or $500 million below what Wall Street was expecting, which means that you've got basically a 10% shave on the top line, which means bottom line is probably going to get hit even worse. I don't like the stock here. I never have. I'd stick with Google, especially Google's down 200 bucks from its top. We're going to talk a lot more about the internet companies, Amazon, Google, Yahoo, and sort of how to play them on our second segment with Michael Arrington from TechCrunch.com.
And the other thing that came across the wires recently was this whole FBI investigation now of these subprime mortgage messes. I mean, and this should come as no surprise, quite frankly. I read a report earlier in the year that shareholder lawsuits will be at an all-time high this year. No surprise.
Absolutely. And what drives me crazy is these regulators are supposed to be protecting the public from these investment banks that have been just trashing our economy. But instead of the government actually doing something about it and actually going after these guys, all we get is more Fed rate cuts. We get more liquidity injections into the system. We get fiscal policy to help out the bankers. You know what? We don't need Goldman Sachs. We don't need Bear Stearns. We don't need any of these guys. If they've been doing things illegal, take them down.
But it's an election year.
Enough said.
Enough said.
Stimulate everything. Keep everybody happy. It's an election year.
It sure is.
Free money for everybody. I want my $2. Let's bring out our first guest.
All right, well, our first guest is here to continue this debate with us. Tom, come on out.
How you doing, Tom? We're going to let you introduce yourself.
Tom Galoma.
Hi, Tom. How are you?
Tom, who do you work for?
I work for Jefferies.
And how is business? What do you actually do inside of Jefferies?
Well,
You're a
I run
bond
the
guy,
U.S.
right?
government trading desk.
There you go.
And
in other words, treasuries. I mean, you guys are back in mostly treasuries, which means you're dealing with hundreds of billions, if not trillions of dollars.
Well, maybe not that many, but we're certainly trading.
It's a big business, though.
Should we be in treasuries these days?
Is treasuries not a bubble?
Well, I think treasuries are still a buy. You know, I think the Fed is going to move by 25 basis points tomorrow. And
so you don't think 50?
I don't think 50. I think there's a 70% chance that they do 50, but the Fed just did 75 basis points.
Agreed.
Right? And I don't really think they necessarily need to do another 50.
And if they go 25 versus 50, does that matter to Treasury traders? It's sort of a bigger picture thing. I had my mom on yesterday, and I was telling her I'm worried that Treasuries are sort of bubbled, and the yields are so low.
They're getting to a point,
and they're maybe going to go even lower. Is what you're saying?
Well, I think they're getting to a point where the 2-year note, I think could trade at 150. I think maybe the 10-year note could trade at 3%.
You should explain that, though.
Okay. Well, the yield on the 2-year note right now is about 225.
Right.
The yield on the 10-year note is about 360. So I think that the 10-year note can rally, say, 60 basis points, and I think the 2-year note can rally, 75 basis points. And I also think that there's also a yield curve play here. We like buying anywhere from 0 to 3 years or 0 to 5 years in Treasuries, and really stay away from the long end of the market because we think all the performance will be on the front end of the curve.
Why? Where do you think we're going to be on the long end?
Well, I mean, I really think 10 years at some point will get to 3%. The last time they were that low was 2003. They got to 307, and that was when we were in sort of a deflationary environment. But I think things are as bad today as they've been in the last 40 or 50 years.
I want to interject here and just sort of explain some of these things you guys are talking about. The short end, you're talking about very near-term expiring treasuries within the first 2 to 5 years.
Right.
And then for the long end, you're talking 10 years or longer. And essentially, you're saying you think the near-term stuff is a better buy than the stuff that's going to expire longer term.
Especially on any backup.
Well, because when you have a long-term bond, you basically have a lot of interest rate risk. You don't know where the rates are going to go.
That's right.
And so that's why it becomes much more risky play.
This is leading into something somewhat interesting, right? Savings account right
I
now
hope it's
are paying twice what the treasuries are.
That's right.
Right? How often do we see this in a normal cycle?
Right, that these curves actually collide.
Inverted like that. Yeah. I mean,
not often, right?
Not often.
So one other thing I want to ask you about is, at this point, is the market setting the Fed's policy? I mean, you just mentioned there's a 70% chance that basically the market itself is pricing in a 70% chance that the Fed cuts 50 basis points tomorrow.
Well, certainly the Fed.
Is the market itself determining the Fed's moves?
It has been. It has been. I mean, certainly what we look at is we look at the Fed funds rate versus the 2-year spread. And that spread got to, inverted by 175 at one point. And, that was telling me that the Fed had to go 75
Now, the people that I've
points.
talked down on the floor want this Fed's fund rate to go back to 1%, back to the good old days, so to speak.
Let me sound like internet companies.
Now, but let me ask you this. Typically, the inverted yield curve is a sign of recession.
That's right. That's right.
So do you think we're in one?
Well, I think we're going to be in one. I think the housing market has been in one for a year and a half. And I think that if we're not in a recession, we're going to one. In the next 6 to 9 months.
But the Fed and the federales throughout the system are doing everything they can to keep this economy stimulated. All they're doing is trying to make sure we don't go into a recession. What happened to risk? What happened to the concept of risk? Why are all investors, the entire investment class, the entire banking system seems to think they don't have to take any risks anymore? Put money to work, it'll always give you big returns.
I don't have an answer for that. I mean, I just don't
in the
know.
near term, though, are they going to be able to bail this market out?
The Fed?
Yeah.
Well, I think with the Fed moving rates down, I mean, my forecast is 250 on the Fed funds rate. I think that's where we're going. I think they're going to
tell everybody where we are right now.
You don't think we're going to one?
Well, maybe eventually. I mean, things could get that bad. But right now, I think the Fed will do 25 tomorrow and do 25 the next three Fed meetings.
And so we'll end up at 250, and then what? The economy will hopefully have stabilized a little, or be so trashed, or hopefully inflation will be so high. What makes them stop at 250?
Well, hopefully the stimulus package will help things. Housing will turn around a little bit. But
that's the thing. The whole
right
thing is going to be camouflaged because those rebate checks are going to show up in people's homes right around the time where these interest rate cuts are going to kick in.
Right.
So no one knows for sure what actually makes the whole framework.
I agree with you, but I think one of the
smoke
components.
and mirrors.
We can pray that it all works out.
Say novenas. I have my mom start.
There you
She'll
go.
be in church on Sunday saying novenas for this economy.
Light some candles.
Yeah.
Thanks so much, Tom. You got to come back. It's fascinating stuff.
Appreciate it. Thank you.
On tab, well, they rose to fame as some of the fastest growing internet companies out there. But will their outlook be as high after they report this week? No. Big scoop, you've got it here next.